Hello and welcome, everyone. My name is Gabe Bodner. I'm with Fairway Independent Mortgage and the Rueth team.
My name is Andrew Christie. I'm a certified financial planner with Flatiron's Financial Planning.
Thank you for attending. And for those of you who attended last month, really appreciate you coming back a second time. This is part 2 of Financial Wellness in Retirement series put on by Andrew and myself. Today, we're really excited to bring to you a topic that a lot of people really don't understand, in my opinion, and a topic that a lot of people need to understand more than anything because it has such a direct impact on their long-term retirement plan. And that's Social Security income and the Social Security income system. So I'm really excited to have Andrew discussing not only a little bit about the history and what the Social Security income system is, but providing us 4 solid tips today on how to maximize your Social Security income benefits. And then I'll be concluding or following up from Andrew of talking about how to utilize a retirement mortgage strategically as part of your overall retirement plan. With that being said, Andrew, I'll let you take it from here.
Thank you very much, Gabe. Let's dive right into strategies on how to maximize your Social Security income. My name is Andrew Christie. Thank you for being here today to learn more about this very important topic that is a foundational piece of most Americans' retirement plan. I want to start with a survey conducted by Northwestern Mutual in 2018 that found that U.S. adults had about 67% of U.S. adults thought that there was a chance they'd outlive their retirement savings. And 78% said that they were concerned about affording a comfortable retirement. That's a lot of people who are worried. And one of the big reasons they're nervous is that they're not sure about the future of Social Security. Is that something that worries you too? Do you think Social Security will be there when it's your turn to start collecting benefits?
I'm worried about Andrew. I don't know, but I'm worried.
You are not alone, Gabe. If you're concerned, we found that actually 3/4 of Americans believe it's not at all likely or somewhat likely that Social Security will be available when they retire. When politicians talk about Social Security, they tend to throw around dramatic words like crisis and bankruptcy. But most people just want to know this: what happens to my retirement if Social Security isn't there to help? Today, I'm here to help you understand what's really going on with Social Security. Specifically, we'll talk about how it works and why it's important. We'll discuss why there's so much concern about the system and what the issues are. And I'll give you tips to help you make the most of your Social Security benefits. So let's start with how Social Security works. The Social Security system, officially known as Old Age Survivors and Disability Insurance, started in 1935. Its intention was to provide some financial protection for working people and their families when they lost their income due to retirement, disability, or death. The original Social Security program only paid benefits to retirees, and later disability and family benefits were added to the program. And today, more than 61 million Americans receive Social Security benefits. Of them, approximately 45 million receive retirement benefits, 10 million receive disabled or dependent benefits, and 6 million receive survivor benefits. Today, Social Security represents about 33% of income for retirees on average. The average benefit as of 2019 was about $1,400 a month or $17,500 per year. And unlike a lot of other retirement programs, you can't outlast your Social Security benefits. Once they start, they keep coming as long as you live. Social Security is also not subject to the ups and downs of the stock market, and it's backed by the U.S. government, pretty much the same way that the government backs the U.S. dollar. So why is this a problem? Why are people concerned about the system? Well, today, the program pays full benefits by using tax revenue and supplementing that with income and interest on the money held in Social Security trust funds. At some point, that's not going to be enough. The government will start liquidating the reserves to pay the full benefits that are owed to Americans. And then eventually they're going to have to redeem the trust funds themselves. In about 2034, the trust funds are projected to be used up and completely depleted. recent news articles circulate. Actually, the last few weeks I've been seeing them showing that that's now projected to be 2033, and it's advertised every year as if this is new news.
Okay, Andrew, so time out. Does that
Yeah.
mean by 2034, there's going to be no money left in the Social Security income system for anybody who goes to retire?
That is not what that means, Gabe.
Okay.
Okay. That's not the end of Social Security. The trustees of Social Security expect that if nothing changes by 2034, 2033, whatever the year ends up being, Social Security will still be able to pay out approximately 75% of the benefits owed to the beneficiaries. 2034 is a long ways off. So what that benefit reduction would look like or how it would be applied isn't really clear. But the good news is that Congress has time to make changes and shore up the system. And those changes could include changing the financing method for Social Security, tax increases, or even pushing back the retirement age. But here's what I want you to take away from this. No one expects Social Security to collapse, Gabe. One way or another, benefits will be there for everyone who's alive today. But because it's not as stable as it used to be, it makes other ways you save for retirement, such as retirement plans, personal savings, more important than ever before. So those are the problems facing Social Security. So what can you do now? Well, the simple answer is make sure you're getting the most out of the system you can. And so we've got 4 tips to help you ensure you do that. The first way to maximize benefits is to increase the amount you're eligible for through Social Security. You can do this by working longer and earning more. You see, the Social Security is based on a credit system. And when you work and pay Social Security taxes, you earn Social Security credits. You get 1 credit for every $1,360 you earn in a calendar year, up to 4 credits per year. And you need at least 40 credits to be eligible for your retirement benefits, which means you have to work at least 10 years to be fully eligible. If you stop working at any time, your credits remain part of your Social Security record. You don't lose them and they don't expire. So if you go back to work, your credits start building up again. Your monthly retirement benefits are calculated based on your highest 35 years of earnings. So your earnings record for Social Security continues to be updated as long as you work and pay into the system. So if you're earning more in your 50s and 60s than you did when you were younger, working longer can push some of those lower income earning years off your record and boost the benefit that you're entitled to. There are other reasons why you might want to work longer too. Paying down or even totally eliminating debt before you retire. You could save more into your retirement plans through your employer and take advantage of their 401ks and company matches. You could also stay on your company's health insurance longer and save money that way. And of course, the more years you work, the fewer years you'll be pulling from your retirement savings. And so the money you have saved will last a little bit longer. The second thing you can do to get the most out of your Social Security benefits is to plan carefully on when you start collecting your retirement benefits. How much you receive at retirement, what's called your primary insurance amount or PIA, is affected by your age at the time you start receiving benefits. So basically you have 3 options. You can take early retirement and begin receiving benefits as early as age 62. You can wait for your full retirement age, which is somewhere between age 66 and 67, depending on when you were born. Or you can delay retirement and receiving benefits all the way out to age 70, at which point there's really no benefit in waiting longer than that. To give you an idea of what that looks like, let's say your full retirement age is age 66 and your expected benefit is $1,000 a month. What you can see in this chart is that by taking Social Security benefits early at age 62, you'd only be entitled to $750 a month. That's a 25% reduction in benefit. Whereas if you're able to delay Social Security all the way out to age 70, that's over a 30% increase in your lifetime benefit. My clients often ask me, if I take Social Security, how long would I have to live before I come out ahead? What should I do? We call that your break even or your crossover age. In general, it's about 12 years. So let me give you an example. We talked about how you can take Social Security as early as age 62, but let's say you take that $1,000 a month at your full retirement age of 66. And let's say that you're single to simplify the equation for a moment. If you wait to take Social Security until you're 66, your crossover age is approximately age 78. So if you live past age 78, you made a good choice and you came out ahead. If you wait to start taking Social Security until age 70, your crossover age is now age 82. So basically, if you live beyond that crossover age, you're going to get more money out of the Social Security system if you live past that. So when's the right time for you to take Social Security? Well, at first glance, you might think, gosh, I just should wait till age 70. But that's not really a blanket statement. There's a lot of factors that come into play, such as when do you stop working, whether or not you're healthy or not, and how much you've saved for retirement, if you're married or single, and who's the primary breadwinner in your family. So when you take all of that into consideration, there are situations where collecting benefits early would make sense. For example, claiming early might make a lot of sense if you're single and in poor health. What if your health is good and the people in your family live well into old age 90, 95 plus? I'm hearing that more and more today in my conversations with our clients. If that's the case, waiting till 70 is likely a good bet. But every person's decision should be based on their financial plan and taking all factors into account. My third tip is to coordinate your benefits with your spouse. That's because if you're married, there's a lot you can do to get the most out of the Social Security, out of your joint Social Security income. You just need to understand the rules. And in general, you're entitled to the higher of your own Social Security benefit, up to 50% of your spouse's benefit. And there are situations when taking a spousal benefit can really help. Think of all the people who set aside their careers to raise their children or take care of other family members. When you do that, your earnings record for Social Security doesn't reflect the value of the time you've spent away from the traditional workforce. And if that's the case, you might receive more money if your benefit were based on your partner's earning records. Or if you're in a career that's emotionally but not quite as financially rewarding, it might make a lot of sense to claim on your spouse's benefit in lieu of your own. You can also receive spousal benefits if you're divorced, but only under certain circumstances. I get asked this a lot. Here are your criteria. You must have been married for at least 10 years. Your ex-spouse must be at least age 62 and currently be receiving Social Security benefits. You can't have remarried when you file. And if your ex isn't currently receiving Social Security benefits, your divorce must have occurred more than 2 years ago. So if you meet all of those criteria, you can claim your spousal benefits. And by the way, your ex-spouse does not have to have filed for their own retirement benefits in order to use that strategy. You may also be eligible for the claim now, claim more later strategy we just talked about for married couples too. I'm not going to go too into depth in that because it only applies to people who are older than 67 today. But consult a financial professional, financial planner, or even directly the Social Security Administration if you have questions, because I'm always amazed. It's the one government agency, Gabe, where I get great feedback all the time. If you schedule a meeting with them, they're very helpful and they can help you plan through some of these strategies. Delaying Social Security can help you also, tip number 4, protect your spouse. Let's say a few years from now, you and your partner are enjoying your retirement and you're both collecting your own Social Security benefits. What happens to your benefits if one of the two of you passes away? Many couples don't realize it, but the surviving spouse can choose to keep his or her own individual benefit or receive 100% of their spouse's benefit. For instance, if you receive a $2,000 a month Social Security benefit and your husband receives $1,000 in spousal benefits, if you die first, your husband can claim your $2,000 benefit going forward instead of their own. For the average worker, Social Security will replace less than 35% of pre-retirement income. So how will you fill the remaining 65% gap in income? I want to go back and stress my point that planning is the best approach. Saving what you can today and combining all of these factors to create something individualized with a financial planner or professional that you trust is the best approach for most people. We've heard a lot of hypothetical examples today. And how do you know what your monthly Social Security payment will be? As I said before, you can make an appointment with their office, or it's as easy as logging in to ssa.gov. They're going to ask you for your social security number, and then they're going to give you an estimate on what your retirement benefits will be, and a lot of other really relevant information on social security. So I'd encourage everyone on this webinar today, if you have not done that in the past, please log in and see your social security estimates. It pays to be informed, and we've covered a lot of ground today. So let me quickly summarize our 4 ways that you can maximize your social security benefits. You can increase your benefit by working longer and boost your earnings record. You can delay your benefits to build up a larger payment. You can coordinate spousal benefits to make sure that you're getting the most out of your combined income. And you can maximize your partner's benefit by understanding how the survivor benefits work. These strategies can provide you with a higher lifetime benefit, and higher income can translate to greater financial security in retirement. Even though Social Security was never intended to be the main source of retirement income for American workers, there's no denying its importance today. And with fewer and fewer pension plans across America, it makes sense to be as educated as you can about Social Security and how it fits into your overall financial plan for retirement. So with that, I'm going to hand the ball back over to Gabe Bodner. Gabe Bodner is going to talk to you about how you can utilize a retirement mortgage as part of your planning to also maximize your Social Security benefits. So with that, Gabe, let me hand it back over to you.
Awesome. Well, Andrew, thank you for that. Tons of great information. Few questions for you before I transition into my slides. Number one, you showed a chart that basically said at full retirement age, which I think you said was around 66 years old for that particular client, would be about $1,000.
That's correct.
And it looked to me as though if they delayed retirement to 70 years old, they'd have over a 30% increase in their overall retirement income. So is it true that if you delay retirement, you'll give yourself approximately an 8% annual pay raise?
8% per year.
Okay.
Right? And I know most American workers, that's not the expected raise every year. So that's a pretty good thing to do. And for most individuals, if you can find a way to do that and take advantage of it for the rest of your life, it's a really good idea.
Okay. Secondly, wanted to ask, you mentioned if you lose a spouse, and I don't think a lot of people know or understand this, but if you are a married couple and you lose a spouse, you have to give up one of your Social Security incomes. Is that correct in what you said there?
That is correct. However, you do get to pick between the higher of your 2 incomes. And so that is still a reduction in monthly income to the household, typically.
Got it. Awesome. Well, again, great information. Loved your tips. We're going to transition over to talking about the retirement mortgage and strategies as well. But before I jump into my slides, I do want to mention, please go ahead and use the chat. Okay. We do have our team here on site monitoring the chat for us. So if you have questions for Andrew or myself, please do send us a message, send us a question in the chat. We appreciate it.
All right. Take it away, Gabe. Thanks.
All right, Andrew. So if you joined us last month, you saw my slides that talked about the 3 buckets. Well, for those of you who weren't here last month, I'm going to go over it really quickly once again. Okay. So these are our 3 buckets. What I talk about, the 3 buckets in retirement and the sacred cow of home equity. Okay. For right now, I'm going to cover the first or the top half of this slide. Okay. So we have 3 buckets. Bucket number 1 is your income bucket. Bucket number 2 is your nest egg. And bucket number 3 is home equity, right? So when you sit down with your financial advisor and you talk about your overall retirement plan, hopefully you own a house, you have these 3 buckets, okay? And in your earnings years, pre-retirement, in your earnings years, you're creating an income in bucket number 1, and you're spending money out of bucket number 1, and your financial advisor is telling you you need to be putting money into bucket number 2. That's 5 to 20% of your monthly income typically is suggested to go into bucket number 2 to create this nest egg. And if you bought a house or you own a house, you also have bucket number 3. That's your equity bucket, right? So your down payment goes into this equity bucket. Your monthly payments, at least the principal portion, goes into your home equity bucket, right? So these are your 3 different buckets. Now, let me ask you a question. Why do you put money into bucket number 2 in your earnings years? Well, yeah, because you need it in order to retire, right? Why? Let's now look at the second half of the slide. When you go to retire, typically bucket number 1 is reduced, meaning there's less income coming into bucket number 1. Most people are either getting Social Security or a pension. Most people are not getting both, right? You might be producing some level of income in retirement through W-2 earnings or 1099 earnings, but in most people's cases, once you retire, your earning potential in bucket number 1 is reduced. Well, that's when you start pulling money from bucket number 2. Bucket number 2 is that nest egg that you put money into every single month and every single year, right? You put money into stocks, bonds, mutual funds, IRA, self-directed IRA, Roth IRA, right? All of these different things, life insurance, cash value life insurance, okay? And the idea is that we put money into bucket number 2 so that it helps create a supplemental income for us in retirement when bucket number 1 is reduced. Now, the challenge with all of this is that most people in traditional thought process of retirement is we're not going to touch bucket number 3. We're going to leave bucket number 3 for our kids. And I have a slight challenge with that because overall, bucket number 3 is an inefficient use of your wealth. As a matter of fact, most people's largest asset in retirement is bucket number 3. So what we're going to talk about today is how to utilize a retirement strategy, also known as a home equity conversion mortgage. And you'll see that acronym on some of my slides, by the way, is a HECM, or a home equity conversion mortgage. We're going to talk about some strategies on how to utilize bucket number 3 strategically and safely as a retirement mortgage so that you can take advantage of some of the strategies that Andrew talked about with potentially delaying collecting Social Security, number 1, or eliminating expenses that are coming out of bucket number 1 as well in order to cover life expenses, right? So once again, as we talk about the 3 buckets, I'm going to come back and reference these throughout my slide presentation. But before I do, I really want to establish what a retirement mortgage actually is. So let's go into the definition of a retirement mortgage real fast. Hit the space bar for me if you don't mind, please. Space bar. Let's see if we can get the slides to, we got a little frozen slide action here. So there we go. Thanks, Nick. I got it from here, I think. But let's talk about what a retirement mortgage is. Sorry, some technological issues as always. But a retirement mortgage, again, also known as a home equity conversion mortgage, is what I call a payment optional mortgage. You see, you can make payments if you want. You're just not required to. Isn't that amazing, right? You can pay monthly, you can pay quarterly, you can pay annually, you can pay every 2 or 3 years, or you never have to make a payment for as long as you live in the home. You still, of course, have to pay your property taxes and home insurance, just like you always would, but you're not required to make a payment. And if you don't make a payment, the interest is simply deferred. Okay? And the interest is deferred until it gets paid back. And you can pay it back again on your own schedule, on your own terms, or never pay it back, like I mentioned earlier. And what this is doing is ultimately converting a portion of your home equity into tax-free cash, right? And yes, you heard me correctly. I said tax-free cash because the proceeds received from the retirement mortgage are not taxable. It's considered a loan. Therefore, it's not taxed as income. And yes, you still get to maintain home ownership. So you still have title to the house. Yes, that's correct. And best of all, it's a non-recourse mortgage. A non-recourse mortgage simply means you can never owe more than your home is worth, and you can never pass on a liability to your heirs. So again, you can borrow some of the equity in your home, never make a payment, and you still own the house. You can still sell the house at any time. You can still pass the house on to your heirs. So let's talk next about how you can extract equity from your home itself. There's a couple unique strategies. Number one, you can do what's called a lump sum. A lump sum is literally taking a lump sum amount of cash out of your home. You can actually do this to acquire a new home that you're going to live in. Okay, so you can use it as a purchase transaction or a refinance transaction, which is the most common type of reverse mortgage where you own your home and you want to take equity out of your home as a lump sum. Number two is a monthly payment plan. And yes, this is again a payment plan in which you receive monthly payments. Notice I didn't say income, okay? You receive payments. And that's why, once again, you don't have income taxes associated with those payments. And there's two different types of payment plans. You can have what's called a 10-year payment plan, which is for your life, or you can have a term payment plan. This is actually the strategy that I'm going to talk about today in conjunction with what Andrew talked about in maximizing Social Security benefits, is the term payment plan. And I'll go through an example here momentarily. And the last and my favorite feature in the retirement mortgage or home equity conversion mortgage is the line of credit. We call it a growing line of credit because yes, the amount of equity you have access to in this line of credit not only is guaranteed for life and it's non-recourse, but it grows every single year. So the amount of equity that you have access to this year versus next year versus the following year will be greater and greater and greater every single year. All right. So let's also, by the way, you can do a combination of any of these. So I'm going to show you an example here momentarily of where you can do a term payment and a line of credit as well. But you can do a combination, like I said, of any of these three strategies, or you can combine all three strategies together. All right. So let's take a look at a slide that Andrew actually pulled up. And this slide shows you what your retirement benefit, Social Security income benefit that is, would be if your full retirement age was 66 years old and you were to receive $1,000 a month from Social Security. Okay. Again, Andrew pulled up this slide, but I want to highlight the ends of the spectrum here for a minute. Okay. If you collected Social Security at the age of 62, you'd get $750 a month. Now, if you delayed till 70, and we're taking out inflation for a minute, okay? But if you delayed to the age of 70, you'd collect $1,320. Now, Andrew talked about reasons why it might make sense for you to delay, and he talked about reasons why it might not make sense for you to delay collecting Social Security. So I'm not here to tell you that you should delay collecting Social Security, but I want to show you some strategies if you were to choose to delay collecting Social Security on how you might do that. Because I'll tell you what, Andrew talked about one of the strategies of working longer. And for me, that's not necessarily the best strategy. I don't want to have to work until I'm 70 years old or 75 years old and then retire. However, at the same time, we all know life expectancies are going through the roof. It's now known and talked about that the individual who's going to live past the age of 120 years old is alive today. Could you imagine retiring at the age of 62 and living to be 120 years old? That's a long retirement. So how do we plan for that? All right. So again, as we compare collecting Social Security at the age of 62, and if you were to collect $750 per month every single month, that would be about $9,000 annually of income. In 8 years, that total income received would be about $72,000. Now, roll that forward until the age of 90, you'd basically receive about $252,000 of income through Social Security. Not so bad, right? Let's look and compare if you were to wait until the age of 70. Once again, you'd give yourself, as Andrew mentioned, an 8% pay raise every single year. And if you deferred until the age of 70, you'd collect around $1,320, which is over $15,800 a year. And that's more than $6,800 additional income every year than if you were to have collected at the age of 62. So fast forward to the age of 90, you'll have received over $316,000 in Social Security income, which overall, by the time you're 90 years old, this is more than $64,800 of additional income received. So that's a lot of numbers. I get it. And what this basically means is, again, talking about Andrew's strategies. And if you were in a position to delay and be able to delay collecting Social Security, where you are healthy and it makes sense based on your discussion with you and your financial advisor, how do you financially do this? Strategy number one, using a HECM term payment. A HECM, once again, is that home equity conversion mortgage. Now, the cool part about the home equity conversion mortgage is that you can set up a term payment for 2 years, 5 years, 8 years, however many years it makes sense for you. But my illustration here is really talking about if you were to retire at the age of 62 and not collect Social Security, but utilize the home equity conversion mortgage for 8 years and then collect Social Security at 70 when you've maxed it out. So by deferring or delaying Social Security, mathematically, you'd be giving up about $72,000 of income. How do we replace that income? Number one, well, again, with the home equity conversion mortgage, you can put the term payment in place and receive $750 every single month for 8 years like clockwork. Now, I also mentioned the fact that these proceeds from the HECM are tax-free, an additional benefit, once again. Now, if you look at this scenario, and the scenario on the slide assumes being age 62 years old and a home value of $600,000 and no current mortgage balance. If that's the case, given current interest rates today, not only would you be able to receive $750 every single month for 8 years straight, but you'd also be able to put in place a $219,000 line of credit on your home. $219,000 of proceeds that you can take out at any time for anything you need. Now, again, those funds are tax-free and they're guaranteed to grow and it's non-recourse. So ultimately, by using the home equity conversion mortgage in this strategy, you'd not only delay and give yourself a pay raise in Social Security, but you could also be putting yourself in a position to not pull money out of bucket number 2 prematurely and wait until your required minimum distributions kick in. And that will also allow the bucket number 2, your nest egg, to grow and ultimately last you longer. So what does this look like? Well, let's take a look at the proceeds received over an 8-year period. Again, that's about $9,000 per year over an 8-year period. It's about $72,000 that you'll receive. Now, let's look at the home and the liability, because that's inherently what a lot of people get concerned about. It's not the proceeds received, but it's about what do I owe, right? So let's take a look at it. Okay, we've got a chart here on the right side of the slide that basically shows you assuming a 4% home appreciation. And now 4% home appreciation annually is the National Association of Realtors historical average rate of appreciation nationally. Okay, and if you assume a $600,000 home value today and a $219,000 line of credit, by the time you're 90, your home value is projected to be almost $1.8 million. Your line of credit is projected to grow to be over $680,000. Once again, you can access that at any time for anything you want with no restrictions, tax-free. And your mortgage balance, yes, you borrowed $72,000 and it's grown to be over $257,000 with the interest deferred. I get it. But take a look at your home value and your home equity. You've got more than $1.5 million of home equity in that home that was $600,000. And you've preserved and protected bucket number 2, and you've maximized your Social Security benefit. So this is ultimately what the term payment will allow you to do in an 8-year period, if it makes sense for you to delay Social Security. Let's look at something else, because the largest expense most people have in retirement is their mortgage, right? So going into retirement with a mortgage payment, in my opinion, could be dangerous. So the example I have for you here is utilizing a retirement mortgage or a home equity conversion mortgage to simply eliminate your mortgage payment. You see, this assumes that you have a $200,000 mortgage balance at 4%, and you're paying somewhere around $954 a month. Imagine collecting Social Security income of $750 and you have a mortgage payment of $954. Just get rid of the mortgage payment, because a lot of people don't realize that $954 actually equals over $343,000 over the life of that loan. And if you are 62 years old or more, and you have 50% equity in your home or more, and you're still making a mortgage payment and you're looking at retiring or you're in retirement, this is the first strategy that I would recommend you take a look at. Because once again, as your income's potentially reduced in retirement, the question becomes, how do we reduce your expenses, right? This strategy right here allows you to eliminate one of your largest expenses, if not your largest expense in retirement, your mortgage payment. Okay? So for those of you who weren't here last month, I'm going to go through some basics. Forgive me if you were here last month, but I'm going to go through some basics on a retirement mortgage. Number one, you do have to be 62 years of age or older. Okay. I'm not 62 yet, but I'll tell you what, I can't wait to get a reverse mortgage or a retirement mortgage. Because the reality is, once you've been paying into your mortgage for all of the years that you have been, and you have all of this equity built up, the question becomes, who does that mortgage payment benefit? Not you. So once again, you've got to be at least 62 years of age, and it has to be your primary residence. Okay. Which means you must live in the home for at least 6 months a year. Okay. You can travel, you can own a second home, you can own a third home. Okay. But it has to be your primary residence where you reside in. Okay. And you do get to keep title of the house, as I mentioned earlier. Okay. You can still hold title of the house. You can still pass the house on to your heirs. None of that actually changes. And generally speaking, it will not affect Social Security or Medicare benefits. Once again, I'm not a tax advisor. I'm not a financial advisor. However, I will tell you, the proceeds received from the reverse mortgage, whether it's a lump sum, a line of credit, or a payment plan, are not considered income. They're considered borrowed funds, so they're not taxable. All right, a few other basics here. Once again, it doesn't require repayment until the last borrower permanently leaves the home, or you choose to sell the home, either one. But you can never owe more than the home is worth. That's what makes this what we call a non-recourse mortgage. And again, if you want to purchase a new primary residence, you certainly can with as little as 30 to 60% down payment, which is age-based. So again, the amount of proceeds you can borrow are based on your age, home value, and current interest rates. All right. So now I'm just going to go rattle off a quick list of a couple strategies and some additional strategies of really how to utilize a retirement mortgage. Because at the end of the day, running out of money before running out of life is the number one concern that most Americans have today. It really is. So, number one, refinance a standard mortgage into a retirement mortgage. Once again, eliminate your mortgage payment, your largest expense. You still have to pay property taxes and insurance. Number two, as a standby portfolio protection, okay, utilize a retirement mortgage as opposed to pulling money from your portfolio, if nothing else, in a down market. That's what we call locking in losses. Okay, so utilizing the line of credit as a standby portfolio protection is a phenomenal way to protect your assets in your portfolio, but also to avoid what we call sequence of returns risk as well. Cash reserve bucket. Okay. Financial advisors, Andrew, he's going to advise you to have at least 6 months, if not 8 months of monthly expenses on hand in cash, right? If you hold money in cash, okay, you're not necessarily making any money, but you can keep cash in your line of credit so that your portfolio can be invested properly. Okay. Next, purchase needed insurance or investment products, cash value life insurance, long-term disability, okay, insurance. These are really important products that we're actually going to talk about next month, but really many people don't believe that life insurance or cash value life insurance is a needed product in retirement, but I actually would argue that it is an extremely valuable product in retirement, cash value life insurance. And this is a way that you can continue to pay and maintain your insurance policy. Investment property or vacation home. Absolutely. So again, the retirement mortgage must be on your primary residence, but you can use proceeds from the reverse mortgage to acquire an investment property or acquire a vacation home. An awesome strategy. The other part is utilize some of your equity to give to a family member, help them buy, right? A lot of people talk about keeping the home for their children, but why not utilize some of that home equity today and help your children buy today? Purchase long-term care insurance. Statistically speaking, 7% of Americans have long-term care, and over 70% of Americans are going to need some sort of long-term care. Okay. This is an absolutely necessary conversation that you should be having with your financial advisor. Long-term care insurance, long-term care planning. Okay. A retirement mortgage can help you fund or finance that as needed. Once again, utilizing home equity tax-free. Bridging the gap. Andrew talked about if you retire early, you may be giving up medical benefits with your employer, which could be a reason why you end up working later. Well, if you're either forced to retire early or you choose to retire early, okay, this could be a great strategy in order to bridge the gap between the time you retire and until the time that Medicare kicks in at age 65. Awesome strategy right there. Hedge against future declines in home value. Once again, I talked about the fact that the line of credit is guaranteed to grow. That growth rate on the line of credit is not growing based on the home value or the projected home value. So as a matter of fact, your line of credit can be going up even if the housing market takes a downturn and your valuation's going down. So this truly is a hedge against the housing market, or some people consider this putting a put on your home. Okay. Gifting to family. Well, I mentioned this earlier about purchasing a home or helping your children purchase a home, but really anything they need. This could be for college savings for the grandchildren. Think about the ability to gift to your grandchildren today when the kids are planning for college, and college is going to cost somewhere between $30,000 and $80,000 a semester, right? And if you live for another 30 years, do you think they're still going to be worried about college savings? Probably not. The need for them is today. So giving today and actually seeing your family receive the benefit and having an impact on that benefit is so powerful. And lastly, gifting to nonprofits. This is a phenomenal strategy where I've had numerous clients want to give to their favorite charity, not just when they're gone, but when they're alive, so they can actually see the benefit and have a direct impact on that philanthropic need that they have. And once again, the ability to borrow money from the reverse mortgage and gift it to a charity, 100% tax-free ability to borrow. So you get the entire tax benefit of that gift as well. Okay. Now, you'll see an asterisk at the bottom of a lot of my slides because I'm not a tax advisor. I'll just say that once again. But a lot of this information really is important to understand that these funds are tax-free because it's not considered income. All right, Andrew, that wraps it up for me for today. So before we take some questions, I do just want to promote our next event that we've got coming up. So our next event that we've got on Tuesday, October 12th, same time, 5:30 to 6:30 Mountain Time, we will be talking about life insurance, and we will be talking about how is it? You tell me. And you're in the space, not me, but give us a quick glimpse into what we're going to be talking about next month and what that means.
Absolutely, Gabe. So next month, I mean, again, I think a lot of us think about life insurance when we're, in our 30s, we're raising our families. But life insurance is a tool that a lot of our clients choose to utilize throughout their entire lifetime. And the need for it, the uses for it tend to change over time. And yet I'm still amazed by the amount of people who aren't sure when they don't need it anymore. A lot of them don't need it anymore, and then they want it. And so it's an important part of your planning. We hope to give you some valuable tools to take away to figure out, okay, is this something that I need to be looking at, or maybe looking at from a different angle?
Awesome. Looking forward to it, Andrew, coming back at this group. And please, again, use the chat. We're here. Go ahead and ask us any questions that you have. Our contact information, we'll put that on the screen. Nick, if you don't mind putting up our contact information on the screen for us. But please feel free to reach out to Andrew or I directly with any questions that you have. I would highly advise, I'll speak for myself, but it's really important, as this is generic information we covered today, but for your specific situation, it's really important that you get a one-on-one with us. Wouldn't you agree that everybody's situation is different, and this information is great, but I think it really has to be emphasized that everybody's situation is different, correct?
Yeah, I couldn't second that enough. Everyone, there are little details, and what Gabe and I are trying to do is give you actionable information and a baseline of education, so that you know when to bring in the appropriate professional at the right time. So I'd encourage all of you, we make ourselves available, happy to answer questions via email, or if a phone call is better, we're happy to jump on the phone and address your specific questions or concerns in a forum where we can ask you a few questions to make sure we get you the right answers.
Awesome. With that being said, Nick, do we have any questions in the chat that you want me to address?
We